Let's examine mortgage insurance and how it's calculated. Basically, mortgage insurance is any type of insurance policy that reimburses a lender if a borrower defaults on the loan. Mortgage insurance is usually required for any mortgage loan that covers more than 80% of the purchase price of the property. This is because lenders see buyers with less invested in a property as more likely to default on the loan and go into foreclosure. While mortgage insurance protects the lender, the borrower is generally the one that pays for it. The trade-off here is that the borrower will also be able to buy a home with a down payment as low as 3% or 5% of the loan. Most buyers hoping to purchase a home but who don't have a full 20% to put down will likely face the prospect of paying a private mortgage insurance or PMI premium as a regular part of their monthly mortgage. That is, at least until the buyer has paid the mortgage down to 80% of the home value. There are two general types of mortgage insurance, private and government. In the government-backed loans, like an FHA loan, the mortgage insurance is paid to the government. If not government-backed, the PMI is paid to a private corporate entity. When a mortgage is insured by a program like the FHA, lenders are often more flexible with the required down payment. Like I said, sometimes allowing the borrower to acquire the property for as little as 3% down. However, the amount that the borrower owes for the insurance policy usually is dependent upon the size of the down payment. Typical cost of mortgage insurance is 0.5% of the principal. So, the higher the down payment, the lower the principal, and consequently the lower the PMI costs. For example, if a couple purchased a home for $300,000 and they only put 5% down, they would have made a down payment of $15,000 and their remaining principal balance would be $285,000. This would mean the cost of their private mortgage insurance would be 0.5% of $285,000 or $1,425. The cost of the insurance will decrease with every 5% increase in the down payment. Therefore, the mortgage insurance is cheaper at 10% down than it is with a 5% down payment. Private mortgage insurance is generally not required with a down payment of 20% or more, and may be removed once the borrower, who put down less than 20%, has paid off an amount equal to 20% of the principal, including any amount they paid as a down payment. It is important to note, though, that lenders are not required to automatically drop PMI until the loan-to-value ratio hits 78%, but the borrower can ask their lender to drop it once they reach 80%, as it's only 2% difference. The equity of a property is equal to the market value of the property after subtracting the amount of outstanding debt owed against it. For example, a home valued at $200,000 with a mortgage balance of $150,000 creates $50,000 in equity to the owner, assuming no second mortgage or other debts have been leveraged against the property. If there is a second mortgage or other liens against the property, that's subtracted from the equity available. So, for the previous example, if there's another lien of $12,000 against the property, then the owner would only have $38,000 of equity in the home. Another way of looking at the equity of a property is to see it as the amount of money an owner would net from selling the property after paying off any creditors.